The information in this podcast is current on the day of recording. It is general advice only and does not take your personal situation into account. It may not be suitable for you.
Hi everybody, my name's John Addis. I'm the founder and editor of Intelligent Investor, and I have with me here today Nathan Bell. Hello Nathan.
Hi John.
I can't see your guitars in there. Oh yeah, there's two guitars in the background there. We'll be getting those out later. If listeners are disappointed, Nathan's going to do some Guns N' Roses solos later on, right?
I feel like 12 more months and I'll be there. I'm only 2 years down now. Much harder than I thought, but 12 months, I promise.
Okay. There's something to look forward to.
I'll even wear the Slash's top hat.
Oh, that'll make it. That'll make it. So we're here today to talk about another in our series of top 10 growth stocks. Today's subject is a company called MF Financial, which would only be familiar to members if they'd read the Ideas Lab back in October 2020 when the company was called Moelis, for reasons I'm sure Nathan will explain. I think we'll kick things off, Nath, with probably one of the best pre-seeds to a bit of research we've ever done, which is just the biggest dangling carrot I've read, I think, from any of your stories. So it goes like this. Ever wanted to go back in time to buy a stock? Buying Moelis today could be like buying Macquarie in 2009. Now, there's no way you could not read that story after reading that pre-seed, but can you start by telling us why was 2009 so significant for Macquarie Group, or Macquarie Bank, as I think it was known back then?
Yeah, so, I mean, we could spend an hour or two probably talking about that period.
Let's not do that, Nate.
Basically, what happened was Macquarie had already moved to what you might remember was essentially a satellite model where it had the traditional corporate banking and institutional banking and all those sort of big services, financial services for big companies. And that's where it traditionally made quite a bit of money. But what it had done in the lead up to the GFC was it produced, people might remember, there was all those other funds that were listed on the ASX, but they were separately listed entities. There was like a lot of property trust ones, for example,
Airports,
office.
I think.
Yeah. So all these
toll roads,
and they just produced enormous fees for Macquarie, because Macquarie would have a stake in those businesses. But what it would do is every time there was a foreign currency trade or there was hedging, or they'll go on to buy these businesses and they're doing there was fee after fee after fee. And if you might, it's interesting actually to go back to some of those old annual reports and actually have a look at the related party transactions, and it blows your mind.
For pages.
And trying to figure it all out was also pretty tough too. But you knew what was really happening. You just sort of didn't need to know all the details. It was just a matter of how much they were taking out. So anyway, what happened was they leveraged those satellite businesses up so much that they blew up. And so a lot of them had to be taken back in-house, or they were recast as something else. And a lot of those sort of externally managed funds, as they were called, became internally managed funds. And unfortunately, I think a lot of the CEOs and management staff of those businesses actually kept on through those businesses, because it's just a bit of the irony was that they were so complicated and there was so much going on during the GFC. They actually needed those people there to actually fix the businesses up and keep them going.
Yeah.
But the realization from that was, partly because of that experience, but also I think that looking at some of the big financial institutions that were becoming more successful overseas, like a Brookfield, was that actually owning the assets was the way to go. And because there's a limited number of transactions you can do for corporate banking and all that sort of stuff, and it's very cyclical. So you get this mad rush of activity, which we're seeing now. Maybe we're starting to see the end of merger and acquisition activity in the market as we get to this end of, or at the end of this big 13-year bull market. And then it drops off a cliff. And if you go to 2009, you can just see that in Macquarie's numbers. Yeah. And so what they did then was they really pushed this funds management strategy, and it's just worked an absolute treat. And the easiest way to see how successful it's been is to compare Goldman Sachs, so the US listed investment bank, with Macquarie, and compare their returns and basically just the productivity and the value created by each business since the GFC. And Goldman didn't make the switch. They just stuck with their traditional banking services. And Macquarie didn't. They've really become a funds manager now. That's more what they are than anything else. And so Moelis has really been following that model, but it's been doing it more from the start rather than sort of, getting halfway through life and then saying we need to switch the strategy.
Yeah. So that 2009 was what caused that switching approach by Macquarie Bank to becoming an asset manager, which is a more reliable kind of business. So what kind of parallels are there between MF Financial today and where Macquarie was, say, 10 or 15 years ago? What do you think are the key things that remind you of those similarities?
Yeah, so I remember when I wrote, so there's a few articles on this on our website. There was the original Ideas Lab when it was very cheap, but it was just really illiquid. So didn't want to cover it. And then I started running out of ideas a bit later on as the market recovered. And I thought, oh, well, I'll upgrade this and try and get it in the funds. And even though I think I've got little hope, and it turned out I did have no hope and just wasn't able to get it in there. And so I think on the website too, it's there's a separate listing there for Moelis and MA Financial, which is I checked that. Yeah, it's annoying. It's a problem we just can't get fixed with our data provider. But looking back, it was one of the comments on the original upgrade from a member was, I just don't see this business has any competitive advantages. And if you've read any of the old investment books, you read about the dangers of buying, something like an advertising agency or a fund manager. And we've seen that with Magellan is probably a perfect case where we stumbled recently, was buying a business where the people leave the building at the end of the night. And that's where your talent and your value goes, because you're always vulnerable to people leaving. But if you ever look at a Brookfield or Macquarie and ask, well, what's really been their secret sauce and why are they different and why have they succeeded so well on the global stage too, and really Brookfield even and Macquarie, like not just in the US and Australia, but all around the world really. They've got smart people and they reward them for it. So, you can argue about, I guess, ethical concerns about the business model and are they really adding any value or are they really just creaming the money for themselves and doing a lot of transactions that aren't really creating value for anyone but themselves. But that aside, they've got a culture. It's very performance based. If you don't perform, you don't have a role there. But if you do perform, you get rewarded very well for it. And that's why the staff costs are just enormous for these businesses. Yeah. And Moelis is really just, just go back 1 second, really formed by a guy called Andrew Pridham. And he met Ken Moelis in America, who was a very well-known banker. And Ken really liked Andrew and said, look, I'm going to give you the capital and you go start up Moelis in Australia. And so Andrew's just really been trying to build that sort of similar mentality of trying to get smart people to the business and giving them money and saying, go and perform, find ways to invest this money and grow our business.
Yeah, it's an interesting story, the beginning of this business, because it seems as though Pridham really had to convince Moelis of the benefits of asset management. They were very, very much bolted on to the investment banking kind of thinking. And it was really him that convinced him to make this break and let him do things differently in Australia. Without that kind of credibility, I don't know whether he'd been successful in talking him into it, but it's just worked out really, really well. So when you look at their latest results presentation, you can see that about 70% of EBITDA comes from asset management. How's that part of the business performing now?
Yeah, so this is probably the most important point about this business and how it's performed since, I was originally talking about it on Stocktake, I think, one of our episodes early on when it was, like it got down to, I think it was $1.29 or something like that was the low point during the bear market a couple of years ago, 2.5 years ago. Or is it 3 now? And it was just illiquid, and the share price was about $5 before the fall. And I remember thinking, oh, well, if it gets back to $5, that'd be a pretty good result. Now the share price ended up, I think it might have actually hit $10 last year, and the earnings just absolutely screamed out of that bear market over the last couple of years. And basically everything's gone right for the company. So you think about all this M&A activity, they've done really well there. So they bought some hotel assets, which were probably poorly timed looking back. But obviously you can't forecast a COVID sort of moment. And so the hotel assets had really been pushed down. And Red Cape was essentially one of those satellite funds like Macquarie used to have that housed a lot of those. And that was performing very poorly, as you'd expect, because all the hotels were closed during COVID due to lockdown. So no one's buying beers, no one's sitting down for dinner, no one's staying in hotels. So you had all these property sort of devaluations or pressure on valuations, and then that all just turned 180 degrees as we burst out of COVID, or at least it burst out of that bear market anyway. And so what you've seen more recently is hotel assets around Australia is like there's just a bidding war for basically any pub you can find on the East Coast at the moment. And so that's been an area where they've been heavily invested. So that's done really well. So their earnings have gone, basically, I think people must have thought it was almost going broke during that bear market. I don't really know why. Its finances are in good shape.
Do you think liquidity might have had something to do with it? Because I think the staff, directors, and there's a lot of inside ownership in this business. I can see why you're very much attracted to that, because it does look like there's this founder sort of mentality in the business. And one of the ways of locking in high quality staff that you need in an operation like this that go home in the lift in the evening is to make sure they've got real financial incentive to make it work. So they've got, I think, 45% of the stock. So it's quite illiquid. Do you feel as though that illiquidity would mean you could have just a couple of investors who are really panicked by the fall, they sell out, and then this thing just drops really quickly and then it comes straight back up after that those transactions have gone through?
Yeah, I think there was another stock I was following probably even more, just as closely anyway, because we actually owned it in the portfolios, was 360 Capital, which has a similar situation where the CEO owns a third of the shares. And I remember waking up one morning and I think someone just must have woke up after a bad dream and jumped on the couch, opened his trading account and sold, I think it was only like $8,000 worth of shares or something.
That might have been me.
And this was like one of the safest companies on the market. Like it had been perfectly set up. Like it was set up for a moment like we had with the COVID bear market, and had been set up that way for a while. So it was as safe as houses. And, the stock fell 12% that morning. And so we had to wear that in the portfolios, even though there's nothing wrong with the stock. So I think that probably is a good sign of the times. I think it's a good point. And the staff remain very heavily invested in the business. And it's a pro and a con. I think it's a massive pro. But on the flip side, the liquidity has been an issue for this business. And American Moelis, so the big sort of head company in the US, and Ken Moelis himself, together currently still own about 20% of the stock. I think Ken owns about 7% and the other 14 or 15 is by the US head stock, if you like. But they've been selling out, and I expect they'll sell out more over time, so they can just focus on their own thing, because it was really about just getting this business started. And I think just they've sort of going their own way, and Andrew Pridham's got things sorted. And the other thing is too, you need to be able to reward your staff with equity. So if you want these people to own staff, over the long term, you certainly need to be creating value to justify higher share prices to see their own wealth building. And you can't do that if your stock's really illiquid, because you just can't get into any of the indexes.
Yeah, do you think that's another parallel with Macquarie? I remember conversations we used to have when Macquarie was really going through that growth phase, about how the staff were owning a bigger and bigger portion of the available equity. Do you think that's a risk in this business, where the staff become very powerful and start maybe getting up to 50 or 60%? Would that concern you?
Look, the one thing for me is, just on the thing is the business share registry is just going to get more and more diversified over time as it gets bigger. I think the two co-CEOs at the moment own, I think it's maybe 6 or 7% between them. And Andrew Pridham still owns, I've got the number here somewhere. He's got 25% of the shares. So I would expect that now he's fairly recently moved back to more of a chairman type role, and the two younger guys who started the business with him, so as co-founders, they're the ones that are going to drive the business from here. So there's really no way. I think the trend is actually the other way. I think Andrew Pridham would probably be more of a seller over time. And it's very, like, if you think of the other two co-founders as sort of 8% shareholders, there's no real way that you're going to be able to reward them enough to get them up to 20 or 30% of the shareholding. And I think everybody knows when they start these businesses is they all want to be in the indexes, and they all want to get bigger. And as you get bigger, you get a more diversified, and you get more fund managers and institutions owning the shares rather than insiders. But you still want that reward there, because you don't want these people leaving. And
so you imagine that liquidity issue might lessen in its impact over the years.
Yeah, I think that's absolutely like 100% definite. We're already seeing Moelis sold about 6% of their holding, which was 20%. So now it's down to that 14 or 15. I think that was about less than a year ago. They sold some shares around $7. So I expect we'll actually see more of that selling over time, not less.
Okay, so we've covered off the asset management division. there's the corporate advisory and equities, which is, I suppose, just similar to what you might call general investment banking activities. Is there anything that they do differently in that division to, say, Macquarie?
Now, I'm not aware that they would do anything different. I think it's all pretty vanilla stuff, but I think the difference is just that Moelis is a much smaller company, so they can do these deals, these smaller deals, if you like, and it actually does move the needle for them, whereas in a way it doesn't for Macquarie. So what you really want is, it's nice when that business grows, and that's why we've got record earnings at the moment. They're saying the company's going to do about 40 cents in earnings per share at the moment. So you go, well, if that's true, like why on earth has the share price fallen from $10 and back to about $5.50 this morning? And basically it's just the market's going, look, interest rates are going up, asset values are falling, and the M&A activity is going to slow down from these record highs at some point. So that's really going to be a hole in their future earnings, and the market's trying to adjust for that. So that's what's going on. But you just can't have that M&A activity going along at the rate it is. And I don't think there's any particular competitive advantage. I think it's just relationships. But I think it's, even though the Moelis, the head stock, if you like, the sort of overseas parent, even if they're not technically a shareholder in the future at some point, I think the relationship is still very strong. And I think that will help Moelis maybe one day being able to do more overseas if it starts to getting a bit big in Australia. So I think that's actually a real valuable relationship, even if it's not necessarily on the share registry in future.
Okay. It's a very different kind of business to, I mean, yesterday I spoke with Gaurav about Lavisa, and you look at the different businesses we have on this list, and this is probably the one that's most leveraged to people rather than an idea or a product. It's a very different kind of business. And in those businesses, the culture is really important, and you need to get the incentives right. What is it about MF Financial that makes you feel as though they've got that right? Is it just the investment that the staff have, the ownership the staff have in the business, or is there something else going on in there?
I think, you're always an outsider with these things. So you sort of sometimes, guessing or have an opinion, and you never know whether you're quite right. But interesting, Andrew Pridham actually wrote a book last year and published it.
Blimey, this is a bit of a shock in finance. I have to check this out.
And actually, I didn't read it, but basically, I read a review of someone who had read it and basically just said it was boring. And I was actually really happy with that, because there was no secret. It was just really about long-term investing and developing relationships and looking after your clients. And it was really simple stuff. But if you do the simple stuff well, it's amazing what you can create. And Andrew Pridham's been at this for a long time, and he's some AFL followers might know that he's the president of the Sydney Swans, and he doesn't mind having a fight with Eddie, Eddie Maguire, who used to be president of Collingwood. So he's not afraid to stand up and have these fights when he needs to, if you like, or these arguments. But at the same time, he understands the whole idea of long-term value and looking after your clients. And it's amazing, like even we even know just from our little business that. When you do the wrong thing, you lose people and you don't get them back. There's no second chances. And so if you really look after your clients and keep doing a good job and keep looking after them, you can create a really, really powerful business if you can keep the talent. And the fact, I've really liked the handover from Andrew to these co-founders. Like, it's been really long time in the making. It's been slow. It's been thought out. These are guys who've been there from the start. And this is a business that started in 2009, listed at 2017. And what I really like now about the business is because it's been successful. I think even with the share price falling back to $5.50 from $10, I think the annual total shareholder return since listing at about $2.35 or something has been over 20%. So if you're the sort of person who thinks, well, I've just finished my degree, I want to go into corporate banking, and I'm thinking about where can I go where I might actually be able to do something really interesting and maybe start a little bit further up potentially than if I go to Macquarie, for example, where there's already a lot of people that you have to be fighting against, whereas Moelis is a little bit new but very successful. And you can see that the equity is building for these people. It's like, well, maybe I can actually do something more interesting and get more responsibility here at Moelis, or MA Financial as it is now.
So that's part of the culture. In terms of the business operations, they've also got a lending operation, again, a little bit like Macquarie, that's gone into residential mortgages. Can you tell us what they're doing in this area? I think they recently bought a company called Finsure, which is a broking aggregator, I think.
Yes. So basically, I just think of this as a mortgage distribution business, very vanilla, no big risks. And you see Macquarie's actually, I think now they're the 5th largest mortgage lender or 6th in Australia now. It's just very easy money. I mean, we're talking about the big banks. It's like they don't even really review a loan application. It just goes through the process. And as long as the boxes are ticked and the proof's all there, the loan gets done. So it's not people heavy. And so what we've seen with this fintech move is everyone's just trying to find new distribution and cheap distribution outlets because the big banks are sort of mature and they find it hard to get new customers. But if you've got these nifty brokers or offering these deals and it can all be done online, which is where people are looking now, then essentially it's just money for jam.
Yeah. Okay, so where would you see the risks in this company then, Nath? Obviously, it seems as though those 3 divisions are all impacted one way or another through interest rate rises. That would be one, I imagine.
Yeah. One thing, it's funny the little things that stick out sometimes with companies that you like. It's just something that's a throwaway line that most people wouldn't notice, but just really sticks in your mind. And the one that stuck in my mind was, I can't remember who said it, but one of the chiefs was doing the results update, maybe it was like 12 or 18 months ago, and said, this is all well and good. Our earnings are going great, valuations are going up, and hotels are starting to perform now, getting over COVID. But, where are we with this low interest rate policy in 2 years when valuations have maxed out? Now, that's not the sort of thing, honesty, you would hear from a CEO.
Oh, that's kind of how to terrify the shareholder base.
Exactly,
that kind of honesty.
And that's what I love. Like, that little thing really stuck in my mind because it's just normally the CEO has become a marketing agent for the business as much as the administrator of the business and staff and all that sort of stuff. So when I heard, so the big risk to the business, obviously in the short term, is the cyclical element, and you only have to go and look at Macquarie's results through those cyclical times and see how it's feast or famine with that M&A and corporate activity stuff. So that's what the market's really adjusted to already. So I think that's actually already in the price. What may not be in the price already, and I'm actually getting pretty positive, like at $5.50 and thinking 10 years ahead. I actually think this is not a bad deal, but I just don't feel like there's a rush to get into it just yet, as asset prices are sort of still falling and haven't sort of, higher interest rates are only just working their way through the economy. So I don't think there's a rush to be in fund managers at the moment. But the cyclicality is the big risk, but the more long-term risk is just you lose one of these co-founders and the business isn't big enough and diversified yet to withstand that change, and the culture really does change, and all of a sudden you've got big teams of staff leaving. That's the absolute big risk to me.
Yeah, I mean, it was interesting to read about. I think James Packer was being advised by the people at MA Financial in regards to the Crown transaction. I think I remember reading that somewhere. They're the kind of relationships that really can build a much bigger business if you're dealing with those kinds of issues. So the staff is a primary consideration. How do you think this lines up against an operation like Barrenjoey over at Magellan?
I've been absolutely amazed at the names I've seen associated with MA Financial, representing people like Packer in the last 18 months. It really has been quite phenomenal. And I don't know whether anything's changed there, that like, would they have got that same deal or relationship 3 years ago, or these long-term relationships? Because, never really heard a lot about Moelis in the past. So I don't know that, but I just love that they're the guys that are winning the deal for whatever reason.
Yeah.
Sorry, what was the other part of that question?
How do you think they compare with, a small, like Barrenjoey, small competitor like Barrenjoey?
Yeah, I think the interesting thing to me is that there's always a battle for market share, right? Because there's only so many deals to be done. It just becomes who's got the best relationship over time. Because obviously, these people are all very wealthy and they sort of all go around in the same circles. I think just in terms of an analytical viewpoint, it's not so much comparing the market share. Obviously, that's always going to be important, but because the bigger issue at hand is if they're actually not getting those relationships, then something's changed at the culture or at the business, or maybe the key people have left. But more for me is actually Australia is a very small market for this stuff, and it's very cyclical. And what happens when even when we go through another bull market in the years to come, there's it's just the Moelis or MA Financial is just a much bigger business now doing these deals. They're going to have to start going for bigger deals to move the needle. Yeah. There's more competition for that. Then you're up against Macquarie and the other bigger investment banks who may not necessarily play at the smaller end of the market. So as time goes on, the markets that will play in get more competitive. And I think that's the bigger issue. And so then it's going to have to look at going overseas. It already actually sort of has a Chinese business, sort of not what I'll call an overseas business, but so that's really what to look out for, because you're just going to run into much bigger competitors who are already well established.
Okay. Now, everything I've seen about the business, apart from the company's website, which is kind of terrible, but in a way that's good, don't you think? Like, they're not too worried about what the general public thinks, and not spending heaps of money on a new website. It's just some bog standard text and some images, and it's pretty poor, to be honest. I mean, we could probably knock this up in an afternoon. I kind of like that sense of focus. They're obviously worried about other stuff that's more important, and it's kind of typical of a young growing business where those things that are kind of marginal, you just push them to one side and say, yeah, let's just get a website done and not spend heaps of time on it because there's other stuff going on, like having meetings with James Packer and finding new contacts and buying new pubs. It seems like an exciting business at this stage. It is interesting to see something that could grow much bigger and has got the right structure to grow much bigger.
My guess is part of that too is it's because it's been an institutional business where it deals with very large clients rather than the retail investors. It doesn't need to have that website that's easy to navigate.
You're just not judged on that kind of stuff.
That's right. And I think that'll be interesting over time, because no one, like if you talk to most investors, even if they've got plenty of experience in the market, they probably even haven't heard of MA Financial or Moelis, because it hasn't been around very long. But as it gets bigger, I would suspect they'll probably start hearing more about it, if not because of the share price performance and the fact that it's just getting bigger. But my guess, it'll start spending more money on trying to get more retail investors to come and buy their products, but they just don't need to yet.
So we've got a hold on the stock at the moment, Nath, I think, and we've got a buy price below $5, is it?
Yeah, that's what I stuck with. I feel like it's almost just a bit of a wait and see. Like Pinnacle's the other one that I really like the business. But the lesson I've learned over the years with fund managers is you've got to buy them when they're growing. The market tends to price them correctly once they mature. And once they mature, they just tend to go backwards over time and have to really struggle to even just keep their share price where it is. And Platinum's a great example. It's just, really hasn't made any money for shareholders since it's listed.
Yeah.
Got a decent dividend, but maybe that gets you to square up, but you certainly haven't made a lot of money. But MA Financial, still to me is early in the growth phase. And just something else I've been thinking about lately is just this line by Charlie Munger, who just said, look, I just got my money, way back when, and I just invested in the best business I could find. That was it. And basically those two businesses were Costco and Berkshire Hathaway. And if you look at Berkshire Hathaway and say, well, why has it been such a great business? Everyone knows Warren Buffett, runs it, but what's the nature of that business that's allowed it to grow so fast with such great returns for so long? And it's really the flexibility of people and money. It's that ability in the sense like, us as a fund manager investing in different stocks, Buffett's taken money from certain areas, we're going way back to the start, like a textile business, and said, we shouldn't be reinvesting the money back in the textile business. X is the next thing we should invest in, or American Express is the next best idea. And then it was Coca-Cola. And that flexibility of capital is really powerful, actually. And I think that's why when you put that flexibility of money with smart people, you can change course in a way you can't. Like if you're Coca-Cola, they got lucky by being able to sell us water, but they sold soft drinks, and they were never going to start selling computers or anything else. Whereas if you're MA Financial and you go, look, we've been in this credit market, for example, and we've been making good returns for 10 years, but the competition's come now and the regulatory changes have meant we just don't make much money anymore. We go, all right, well, we'll close this down and we'll invest in something else. And there's actually a lot of value in being able to do that.
Yeah, it's very entrepreneurial. And when you think about Buffett and his history, the idea that you could start with a printing press and a local newspaper and end up as one of the biggest shareholders in the world's biggest tech company in the course of an investment lifetime just shows a kind of flexibility and mentality that we should all kind of aspire to, I think. That ability to turn away from one thing that's reached its peak and look for something else that has that growth ahead of it.
It's astounding. I know there's a lot of people sort of hating on Buffett over sort of as he gets a bit older, and they probably haven't made the most of some of the opportunities they've had, particularly that bear market from a couple of years ago. And I think also the GFC, where he did some really good deals of financing companies and got a nice return, but he actually probably could have gone and bought some whole companies at the time and done much, much better.
Yeah, they were calling him up.
And so I don't really hate on Buffett. I think he's been incredible, and I think the fact that he's actually in Apple now and owns so much of it, like you said, and he's been finally able to. Maybe it was later than what it should have been, but the fact that he's gone with it now and he continues to beef up the Apple stake, I just think the man's astounding. And I'm sure when his time comes, there'll be the people. I'll actually be quite sad when him and Charlie are no longer with us, because they, even though actually I've talked to him very briefly once, but when they signed our dollar bill, but when the fact that they're gone, I think it'll be quite sad, because they've really done more, I think, for individuals and investing than anyone I can think of. Way more.
Yeah. They've been in education in themselves. I think, especially for me, Charlie Munger was. I mean, I think I've read almost everything he's written, and their ability to communicate is really, really underestimated. I think it's not just their investing ability. Just thinking on those lines, though, Nath, before we wrap this up. Do you think that co-CEO, which is an unusual arrangement, having a co-CEO, Pridham has set up this co-CEO arrangement. Do you think he's done that, having looked at Platinum and looked at Magellan, and see how that key man risk is something that can really, really devastate finance businesses? He's doing that to try and avert that risk?
I certainly wouldn't underestimate his thinking, because he's been... essentially, he's been grooming them for this role for, I think they took over officially maybe 12 or 18 months ago. So we're going back to 2009, since he was essentially the top guy running the business and really driving it hard as an executive, as opposed to a chairman type role. He's not officially the chairman. I think he's got some sort of strange vice president chairman role, whereas it feels like he sort of just gets involved when he needs to now. But I think he's a smart guy, and I think he's built this business to go the distance. And I'm sure that with these guys by his side, they've all worked together as a trio for, 13 years now. And he finally felt the time was right to hand over the responsibility to these guys. Pridham's not a young guy anymore, but certainly capable of doing the job for many more years to come in the current role. But I just really love that. It was seamless. Everything's been seamless with this business. They've over-delivered. I'm just
and they're talking themselves down. What more could you want?
Well, I just really like it. There's no guarantees in life, but I just know if I can find 20 businesses like this, I'm going to do great.
Yeah. Okay, that's a great note to end it on. Thanks very much, Nath. If members are interested in this stock, keep an eye on the website. We hope to get a chance to upgrade this in the next few months. It's already in one of the portfolios, I believe, Nath.
Yeah, it's just a very tiny
very
holding.
Small holding. Nathan regrets not buying more when he had the chance, but he shouldn't feel bad about that. Thanks very much, Nath.
Pleasure always, John.
All right, cheers. See ya.